Assalamualikum OyaRahmatullahe OyaBarakatuhu. Innal hamdanillah wassalatu wassalamu ala rasulillah. Amma ba'd. Bismillahirrahmanirrahim. This is Muhammad Kamrul Hussain, Department of Business Administration, Metropolitan University, Sylhet. Welcome to my virtual classroom, MKA Classroom. Now let's start today's video tutorial.
Today we will try to discuss business activities or types of business activities. Basically, business activities are four types: planning, financing, investing, and operating. Basically, these are the four business activities which are done every business firm to earn profit. That's why these are called the business activities, because every organizations are done these four activities for earning profit. Later on we will try to discuss these activities. First one, planning. Planning actually is a very important task for the business firm. Very important, because a good plan is a half done work. That's why it is a very important things, and every business organizations prepare a good business plan for their activities. A company exists to implement specific goals and objectives. A company's goals and objectives are captured in a business plan that describes the company's purpose, strategy, tactics for its activities. So it is describe company's purpose, company's strategies, company's tactics, etc. described by this business plan. A business plan assists managers in focusing their efforts, identifying expected opportunities and obstacles. Two important sources of information of a company's business plan are letter of shareholders, that's called the chairperson's letter, and management's discussion and analysis, MD&A. So these are the two things, two sources of this information of business plan, which are help to a business to reach its goal. After that we will see financing activities. This is the another important activities for any kind of business organizations, that is the financing activities. A company requires financing to carry out its business plan. So at first we see the business plan. If the business plan has to carry out, this company or this business firm need finance. If there is no finance, then there is no plan, there is no business activities. That's why there is another important task for a business firm. A company needs financing for purchasing raw materials for production, paying its employees salary, wages, implementing marketing campaigns, and research and development for the betterment of their product. So all the things you need to improvement to survive in the market, then you need financing. You will see purchasing raw materials for the production. If there is no raw materials, there is no productions. So you need finance to purchase these raw materials. Paying employees salaries or wages. If you do not pay salary to your employees, then your firm will stop. No one will wish to work with you without pay. There is very simple things. Implementing marketing campaigns. So you are seeing advertisement in the televisions, that is the marketing campaigns for enhancing selling their product. And later on, research and development of their product. So you are seeing one after another development of product, and that development can be held by this research and development. So that is the things you need to finance of that taxes. Financing activities refer to methods that the companies use to raise the money to pay for these needs. Because of their magnitude and their potential for determining the success or failure of a venture, companies take care in acquiring and managing financial resources. There are two main sources of external financing. One is equity investors, another is creditors. That means for the lenders, and equity investors were the owners or shareholders. They are the two main sources of this external financing. Decisions concerning the composition of financing activities depend on condition existing in financial markets. Financial markets are potential sources of financing. Investors provide financing in a desire for a return on their investment after considering both expected return and risks. So we are talking about equity investors. So obviously investors are desire for their return. Return is the equity investors shares of company earnings in the form of either earnings disbursement or earnings reinvestment. Distribution or earnings reinvestment. Earnings distribution is the payment of dividend or to the shareholders. Cash dividend or stock dividend. So that is the investors' desire for getting return for their investment, and these earnings or these returns are paying to the investors as a dividend for the equity investors. Credit investors can get the interest. Dividends can be paid directly in the form of cash or a stock dividend, or indirectly through stock repurchase. Dividend payout refers to the portion of earnings distributed. It is often expressed as a ratio or a percentage of net earnings. Earnings reinvestment or earnings retention refers to retaining earnings within the company for use in its business. This is also called internal financing. Earnings reinvestment is often measured by retention ratio. The earnings retention ratio reflecting the proportion of earnings retained is defined as 1 less the dividend payout ratio. Equity financing can be in cash or any asset or service contributed to a company in exchange for equity shares. Private offering of shares usually involve selling shares to one or more individuals or organizations. Public offerings involve selling shares to the public. Private offerings selling to shares or more individuals or organizations. Public offering for public. Companies also obtain financing from creditors. Creditors are of two types: debt creditors who directly lend money to the company, operating creditors to whom the company owes money as part of its operations. Debt financing often occurs through loans or through issuance of securities such as bonds. Debt financiers include organizations like banks, savings and loans, or other financial or non-financial institutions. Operating creditors include suppliers, employees, the government, and any other entity to whom the company owes money. That's the equity operating creditors and debt creditors we are discussing in here. Then investing activities. Another important things are investing activities. You are getting fund from the financing activities, and now your responsibility is to invest your fund. Investing activities refer to a company's acquisition and maintenance of investment for purpose of selling products and providing services, and for the purpose of investing excess cash. Investment in land, buildings, equipment, legal rights, inventories, human capital, information system, similar assets are for the purpose of conducting the company's business operations. Such assets are called operating assets. As also, companies often temporarily or permanently invest excess cash in securities such as other companies' equity stock, corporate and government bonds, money market funds. Such assets are called financial asset. So here we are seeing that investment activities are relating in the two major assets: operating asset and financial asset. Whenever the investors invest in land, buildings, equipment, legal rights, patent license, copyrights, inventories, etc., etc., there is a operating assets. Whenever the investors are invest their fund in the company's stocks, shares, bonds, then that's are called the financial assets. Investing decisions involve several factors such as the type of investment necessary, amount required, acquisition time, asset location, and contractual agreement. Like financing activities, decisions on investing activities determine a company's organizational structure, affect growth, and influence riskiness of operations. Investment in short-term assets are called current asset. These assets are expected to be converted into cash in the short-term period. Investments in long-term assets are called non-current assets. And last one, operating activities. One of the more important areas in analyzing a company is operating activities. Operating activities represent the carrying out of business plan given its financing and investing activities. Operating activities involve at least 5 possible components: research and development, procurement, production, marketing, and administrations. A proper mix of the components of operating activities depends on the type of business, its plans, and its input and output markets. Management decides on the most efficient and effective mix for companies' competitive advantage. Operating activities are a company's primary sources of earnings. Earnings reflect a company's success in buying from input markets and selling in output market. Actually, these are the business activities which are done by every business firm. As you know, planning, financing, investing, and operating. These 4 core activities done by a business firm to earn profit. Thank you.
This all about today. Stay home, stay safe, try to maintain a safe social distance. Try to wash your hands frequently in a day. Subhanaka Allahumma wa bihamdika ashhadu an la ilaha illa anta astaghfiruka wa atubu ilaika. Assalamualaikum warahmatullahi wabarakatuhu.